Good evening, everyone. Hope you're well, and thank you for bearing with me. 1 minute late, but we are here. We're live. Thank you very much for joining me and for getting ready for tonight's presentation, tonight's live stream. My internet is doing okay, but it may at times break up. The audio might break up, so just bear with me. We're doing what we can to make sure that we bring you this as clearly as possible. If there is any problems, chuck them in the comments so that we just know how we're running. But fingers crossed we do all right. But first of all, yeah, we are live, and tonight we are talking about how to beat rising interest rates and capitalize on the economic downturn, or the changing economy, as we could say. So tonight we are going to cover the 3 changes that will impact property investing, how to beat rising interest rates, and of course I will always make you an exclusive offer just at the end. And then we'll go into a Q&A, so I can hopefully spend a decent amount of time answering your questions. Today we're running for about a total of 45 to 60 minutes. Normally it's to 60 minutes because I like to do a decent amount of questions. And today, as always, I do really tend to target the beginner property investors. I want to add value to those that are just getting into the industry. But I do think actually there's some golden nuggets today for anyone that's even a bit more advanced and just wondering, what mindset should we go into this kind of changing economy with? To answer that really is this t-shirt. I'm wearing the long game t-shirt, bringing out the OG t-shirt, because today we are going to be talking about some mindset and skills and things that we can take into the next 12 months. First of all, hello to everyone in the chat. Thank you very much for being here. And 4 things before we get started. Number 1, please stick around to the end. Let me go big screen here. Please stick around to the end, because that's where we can really get some of the gold out. It's in the Q&A, and I can answer some of the questions that you guys are thinking about. Number 2, if we can bring out your notepad, make some notes. Today you are taking a step forward in your property investing journey. Number 3 is this is not financial advice. As much as I like talking and obviously sharing everything I do about property, and I think it's valuable, this isn't financial advice. Learn about what I say, question what I say, and then research it and apply it yourself. But most importantly, today is about commitment. I really want you to commit to taking this information, taking on board what you want to do as an investor. Think about that, and then don't look back in the future regretting not taking enough action. As always, a little bit about me. I'll skip through this quite quick because I'm hoping that some of you will know who I am already. But I used to be an estate agent. I did it for 7.5 years, and I always used the photo on the right there. So I wanted to add in some others of me thinking I look great and taking photos of myself, of course. And on the left there was actually when I didn't really earn very much money, but any money I did earn and then went and spent it stupidly. So at one point I had 2 at the time were quite nice cars, and that white MR2 is still one of my favorite cars to this day. But anyway, most importantly, I was an estate agent in the last economic downturn. So I started in 2009. I thought that this was kind of the limit of estate agency, but actually it turned out I just started estate agency at the wrong time, and actually things only improved and got better from there. But actually learning how to deal and sell houses and everything at that time was very valuable, very useful, and I didn't realize it until later on. Now I am full-time in property, which honestly is genuinely the most amazing thing in the world. I thoroughly enjoy it. And I thought I'd share with you some of my credentials, which is, I purchased 6 properties to date. And the first one was in 2015. That was, of course, like my first property was more of like a home. Then moved into, it's a 4-year gap, then moved into buying my first buy-to-let 2019, the bungalow 2021, which is an ongoing saga. Then moving on to more into the buy-to-let world, in the first BRR in 2021. And then I've done 2 properties so far this year, hoping to at least get to like 3 or 4 before the year closes. But never-ending issues is making that more difficult than I'd imagined. I've also sourced and sold over 50 properties to date now, which from what I understand is pretty good, pretty quick, and has given me a vast amount of experience. Doing this has been one of the best things I've ever added as part of my skill set. I invest and source in property over 5 hours away from my home, and I do all of this under the Propertyx branding. So hopefully, as I said, I've done that quite quickly. I'm hoping that a lot of you guys know who I am anyway, but that is me. And the first place I want to start with today is the 3 major changes that will have an impact on property investing. Now, we have to cover these 3, although they're quite simple, they're quite basic, and I'll roll past them fairly quickly. We have to cover them to kind of know and move into and transition into the 5 things that I'm going to be focusing on and that I'll encourage others to focus on during the next 6 to 12 months. So obviously the first thing that's going to impact property investing already is here. It's the cost of living crisis. Fuel has gone up. Everyone's bills are going up, which is, a couple of days ago, I think went up again, which is fantastic news. And of course, for anyone that's, perhaps nearer towards the average salary, it's been a really tough time because the average salary has just gone up peanuts. And the percentage is nowhere near in correlation to obviously the increasing price of fuel and the cost of living, let's say. And why is that a problem? Well, the more that we stress those that are perhaps, and I mean this in the nicest way possible, the more that we stress those at the kind of average salary level, the more likelihood that there is for people to default on their mortgages or even stop paying rent, which obviously we need to know about as landlords. But more importantly is obviously for people defaulting on their mortgages. The graph you can see in front of you, we're looking at the orange bars, not the grey line. The orange bars shows the amount of repossessions. Now, the one on the peak on the left-hand side is in the 90s, which was the worst crash. And the peak on the right-hand side is the more recent one, the 08-09 crash. And as you can see, repossessions really are a big part of what goes on when we have an economic downturn. And we just need to be aware of that. And I'll tell you why we need to be aware of that. And that's from a recent article that came out that not many of people are aware of. And this is actually very recent. So mortgage shock awaits UK home buyers after pandemic tax break. Now, effectively, without reading you the whole thing, effectively what this means is that during 2020, 2021, 42% of new borrowers, so whether they were taking out new mortgage or actually whether they were remortgaging, 40% of borrowers fixed for only 24 months. And that's according to data from UK Finance. And what that does mean is that 42% of these borrowers of mortgage borrowers in the UK are due to refinance in September 2023. That's 42% of people in the year that they were taking out that mortgage, not overall. But still, that's an incredible amount of people that are going to be coming up for remortgage in 2023, and at which point their mortgage cost potentially could be 25% higher. Why is this important? Well, as I've just said, if people are already being pushed to the absolute limits by the cost of living, and then you find out and you see that actually they're also going to be hit by much higher mortgage interest payments, it's going to really push people to the limit. So we could see more repossessions. We could certainly see more people trying to sell and at worst case losing their houses. So I've kind of touched on it there, but the second thing really is rising interest rates. We've quite quickly gone from the lowest ever to 2.25% this year, as you can see from the graph on screen. And there is a prediction by several banks and finance people that we could end up at 6% in 2023. Do we believe that? Do we not? Right now, I don't know. With the way that the mortgage market has been the last 4 weeks, I would say, yeah, potentially we might be. So we do need to be factoring in the fact that interest rates are rising. And of course, this will have a big impact on investing over the next few years. I'll give you a quick example of this. If we purchase a house at £100,000, let's say it's a buy-to-let, we have debt, mortgage of 75%, which is £75,000. If we rent this out for £700, our interest-only mortgage at 3% is £187.50, which is lovely. But if it's at 5%, it's almost double. It's £312.50. And then at 8%, which we have seen in the past and we may see in the future, it's then at £500. So when you then take into account the fixed costs that you have, such as a managing agent, insurance, then all of a sudden, as you can see on the right-hand side here, your profit has gone from being over £400 to now £96 at the 8% interest rate. And I just want people to understand that, because it might not affect you now whilst you've got a fixed mortgage, but if you refinance during a time which interest rates are higher, which the likelihood it will happen in your investing career, you need to understand what impact that has on you. And we say it's £96 profit, it might go great, it's fine, you know, it's profiting. But the problem therefore is if your tenant then leaves, if they stop paying, if there's maintenance issues that come up. Not only that, but I've also not included accounting fees or tax in this example. So even if we were getting excited about £96 per month, I've now taken that away from you. So I'm sorry. So the last thing really is going to be, obviously, you know, a housing market crash. That really will affect our, obviously, investing, how we invest, and obviously we're going to move into that shortly, you know, exactly how we might deal with that. And let's face it, you know, the media are really going to town on this right now. They've, you know, not allowed to talk about other things that we've had in recent years now. So now they are jumping on the wagon of the potential crash, with some articles looking like this. You know, more than 40% of mortgages withdrawn as the market reels after the mini budget. And to be fair, you know, when you look at the economic side of things, when you see the amount of mortgage products which were taken away in the last couple of weeks, 40%, then it does start to scare people. And even me as an investor, you start to think, what is going on right now? You know, we're living through very interesting times. And we have to think, you know, if a recession does happen, then what happens to the mortgages? Well, less available mortgage products. We have higher interest rates, and there is also more capital required for purchases. You know, we can no longer do maybe 20% deposits like we have done sometimes in the past. And if we want to get better rates, you might have to start looking at putting 40% or 45% down, because the lender wants us to de-risk that asset from future issues. I'll give you an example here. Dave, I've chosen Dave here. He's joined us today. Dave has 10 buy-to-lets. They all profit currently at £200 per month, all of them exactly the same for this example. £200 per month. He's got 10 of them. They make him £2,000 per month. Am I back? If anyone can hear or see me, that would be amazing. Just let me know. I think we're up and running again. I deeply, deeply apologize about that. Thank you for everyone who has stuck with me. Thank you, Harry. Appreciate it. And yeah, apologies. I hope that doesn't happen again. But at least now we know how to get back quicker if it does happen again. So let me get back to talking to you about Dave. Dave here has 10 buy-to-lets. I don't know how far I've got, so I'll quickly run through it. But makes £200 from each one, £2,000 per month. If all of Dave's refinances come up in 2023, which, let's hope they don't, Dave's interest-only mortgage payments could increase from £150 at 3% up to £390 if he was remortgaging at 7.5%. So we've quickly gone from earning quite a reasonable profit, average profit, I would say, to now we are £40 a month times 10. We're now minus £400 per month. And that's before any maintenance, any voids, any tenants are not paying due to recession. So, it doesn't sound too bad, but to have to be servicing debt and paying debt at £4,800 per year is not ideal if times are tight already. Now, we're kind of thinking a little bit doom and gloom, worst case, but I think it's always best to know exactly what could happen. And I think that's one of the main questions that I get is, well, how could I lose my properties? What does happen in a recession if I've already bought the house? So I'm still here from the looks of it. So thank you to everyone that stuck with me. We're actually getting to the good part now. So now we've gone through the 3 reasons why it's going to, what will happen to the property investing market or what's going to impact it. Now we can actually think about 5 principles that I'm going to rely on to capitalize on an economic downturn. And just a quick reminder that, I am an estate agent, or have been. Sorry, I'm not an estate agent now. My mind's completely thrown off. I was an estate agent for 7.5 years, but I'm no longer one. And therefore, I'm no longer in the game every single day. And I'm an investor, but I've only been for 3 years. I wasn't in the previous crash. So what I know is what I have learned and my understanding, but obviously it's not living examples. And then last of all, I've been a sourcer for 1 year, but anything I share with you now is just the views of my own. It's not financial advice, but this advice really has been passed to me from my own mentors and other experienced investors that I know. But the first thing that we should do is we should stop watching the media and do that now. Okay. I know it's sometimes quite interesting and it's, if we've got a boring day on at work, it's great to get on there and it's, I guess probably changes the way we feel about that day, but that's exactly having a negative impact on you as well. So, get rid of any notifications, anything you have set up to the media, I'd get rid of them straight away. And then I'd also, if you're buying a paper every day, stop buying the paper. That's just a very simple one. I just wanted to throw in there because I think that is probably one of the best things you can do to keep your mood, your level under control. And the reason I mention that really comes from my own experience. And as I say, before we move on from this one, I'll give you this experience. And that is this property here in the green. It was my first buy-to-let. And obviously I'm joined by Boris down here. And the reason I sort of relate these two is in 2019, I was doing a lot of trips to Liverpool. I was doing a lot of viewings, making offers, and a huge amount of people told me to not invest. What are you doing? This is crazy. Brexit's going on. Once Brexit, if Boris gets Brexit done, there is going to be an economic downturn. 2020 is going to be disastrous. And a lot of the time I was listening to people that, weren't necessarily investing themselves, and they were just chiming in on what they'd heard on the media, and they were just sort of, regurgitating it towards me. So what I've done really is I kind of said to myself, well, what is the worst case scenario here? If I always look at the worst case, well, actually, if I fix a 5-year mortgage, that will hopefully well and truly clear any changes in 2020. And if I also, know that it's going to cash flow this amount of money per month, I buy it for this much money per month, and I've locked it in for 5 years, I will outsee any kind of economic downturn. And as a result of that, and I'm a big believer in one decision can often really impact the future of your life. And this really did for me because, would I have the same buy-to-lets I do now? Probably not. Would I have my YouTube channel? Probably not. Would I have started Propertyx? Probably not. Would I be a full-time in property? I believe I'd have got to all of those things eventually, but would I have had the same outcome? Probably I wouldn't. So remember to think for yourself, try and block out the noise, and then of course apply sort of calculations and knowledge to every decision you make rather than what someone else is telling you. And this really brings me on to point number 2, which is reprogram your mind to think long term. And I'm going to kind of walk you through how to maybe do this. But now more than ever, you know, as you can see from my t-shirt, I've always been a fan of the long game. None of this, you know, financially free in 7 days bullshit, but more actually, what can we do to play the long game? You know, how can we get rich, big time rich, wealthy over the long term? And this is something that I believe we should all do, particularly at these times. And the first thing we need to learn really is that recessions are necessary. They're part of the way the economy works and the way that you know, you can't always be going upwards. You kind of have to ride this wave up and down. And we kind of need recessions in a way in order to reduce inflation and a whole host of other reasons. But a very famous Warren Buffett quote, I hope you all know who Warren Buffett is, but if not, he is obviously very famous within the stock market and the companies that he owns, such as Coca-Cola, owns a large portion of. And his famous quote is, "Be fearful when others are greedy and be greedy when others are fearful." And I think that's really, really important to relate that to property, because already I'm starting to see people start to slightly get fearful. And it always interests me when that happens, because this is the time that we've been waiting for over the last 2 or 3 years. And we just need to remember that actually, instead of riding these waves, instead of purchasing in the peaks because of FOMO, selling in the troughs because we are, you know, worried about holding on to properties during this time, we just need to kind of ride that winning line, which is always be buying, always be improving, always be building on that portfolio, but sensibly and obviously taking calculated risks. And now I bring you on to the 18-year property cycle, which I have renamed the property cycle, as really we can't call it an 18-year property cycle anymore, because it's probably more like a 13 to 20-year property cycle. And although the years are inaccurate, and although this is, you know, probably wrong now, what I will say is that the property cycle, follows a very similar trend. We always have the recession, the recovery phase, a little mid-cycle dip or wobble, then we have more explosive growth, followed by obviously the actual recession itself. In theory, we are kind of at this top point of the peak now. If it's true, if everything continues to play out as the way we are potentially at the top of this explosive phase of growth that we have seen recently. And obviously during the explosive phase, we'll have different methods of investing to what we will in the recession phase. In the explosive phase, we'd obviously look to lock in interest rates. You know, lending is a lot easier. I think I certainly took it for granted how easy it was to get a mortgage the last couple of years. Obviously, it's a great time to sell, to do flips, because you can literally buy a house, sit on it for a few months, and in the recent year or two, you've been able to sell it at a profit without doing anything. And then obviously it's a good time to refinance because of that as well. So it's great for the buy, refurbish, refinance method. And for a lot of us, it's been a great time to build up a war chest, build up a pot of money that we can then take into the recession phase and start buying. But what we need to remember is that, you know, be greedy when others are fearful, and actually use that war chest and go like, this is the time to buy. Because when this happens, you know, interest rates are higher, the lending is harder, and therefore people panic. But this is a great time to purchase and hold. We just need to understand that there is more equity tied up for longer. And it's the people that buy now that will probably be able to double their portfolios in 2025, 2026, 2027, when we see the other side of if we do have a downturn, if we see the other side of that, then they're the ones that will come out laughing because they continue to buy during this process. And I shared this in a recent live stream that I did about a month ago. Blackstone, the largest real estate company in the world, I believe the 24 billion pounds worth of commitments were raised in the last a few months ago now. This was July, sorry. And they raised this money because they want a huge war chest to go into the next few months, the next year or two. And the same with this US real estate firm, Carroll. It's not a lady Carroll, it's actually a company called Carroll, who raised £340 million to buy multifamily units in the US. This is, in fact, the gentleman on the left is Mr. Patrick Carroll, who owns that company. And then the chap on the right is Mr. GC, Mr. Grant Cardone, Uncle G, however you know him. And they are probably well and truly smiling right now because they are champions when it comes to raising money or having that big war chest and then investing it into property. And they've been banging the drum of a recession for a couple of years now, and they've been ready and waiting to get buying when it happens. So just to recap that, really reprogram your mind. As I say, these guys we know are billionaires, big time billionaires, and they're excited about this. What should we be? Maybe we should be excited. Maybe we should be thinking long term. How can we utilize this opportunity? Number 3 is learn how to invest. And I don't mean that like sounds really patronizing, I think, the way I've written that, but I don't mean it like that. But what I mean is that we need to just, go back to basics, relearn how we should invest in property. Now, the first thing with investing, when you have money coming in and money going out, is budgeting. And this is actually a screenshot, he won't mind me sharing it, of one of the Propertyx Program members. We went through his finances recently because he was, how can I save more money? How can I build up capital quicker? And also, I'm a bit worried about my job. What can I do if I was to lose my job? Well, the first thing we need to do is cut expenses. What can we get rid of? All these subscriptions we don't need. So get rid of those, and then obviously keep anything that is actually a sport activity, something that's good for our brains. But this is, the first thing you can do is cut your expenses. Then you can, retain a 3 to 6 month buffer emergency fund. If you're really worried about this and you're saying, I just don't feel right about investing, I'm not sure about it. Well, then make sure you keep that buffer, keep that emergency fund, and cover your expenses. So if your expenses are $1,500, have £4,500 to £9,000 ready in the bank, so that if you are investing a load of money and then things do go wrong, well, you've got this little bit of money here as an emergency fund to see you through 3 to 6 months. And then choose your asset, which for majority of us on here, I would imagine, I believe, is property. Learn how to invest property. Otherwise, your money will literally be eroded away by inflation and by the economic changes. How can we learn how to invest this money? Where can we learn? Well, there are tons of books out there. There is tons of property networking events. And I'm not saying you have to go network and raise finance and meet people and shake their hands and do all the cringy things that you do at networking events. But I think just get out there, get into the property environment, feel confident and get other people's views on what's going on. But just don't be stuck in a bubble of people at work or people that you live with that maybe don't enjoy property and feel a bit more doom and gloom about the world. Get out there and see other property people. And if you find that difficult, maybe just work with a mentor. Obviously I've had mentors, I am a mentor, just work with someone that can help push you through this time. Because you are also an investment, and money, assets, cars, watches, worst case scenario, all of these things can be lost. And I don't mean that as doom and gloom as it sounds, but if you lost your job, if you lost your house, if you lost all these things, you lose all of them and you literally are at ground zero. Whereas if you'd invested into books, networking, mentors, building up your own knowledge, your knowledge and skills can't be lost. You can take those on to the future. And what you will invest into your knowledge one way or another, whether that's through wasted time, mistakes, or education. Trust me, I've been there. I've made mistakes in refurbs, and the only way to get through those is to invest in some ways. In a way, the mistakes I've made have been an investment, but so as working with mentors or going to all these events I go to, talking, doing my YouTube channel, everything like that. Now, I think hopefully these are the parts where maybe you can really take value from. I believe what I've said so far is kind of a little bit like, okay, yeah, obvious, but kind of needed to be said, needed to be reminded. Now I'm moving on to the parts where I hope actually the 4 and 5 will help you think when it comes to your own investments the next few years. And the first one is, create a property business plan. Because, if we go and start a business tomorrow, a huge percentage of us are going to go, right, I need a business plan. And I'm going to write down, my target audience, how I'm going to make money, how many products I'm going to sell, who my first hire is going to be, you name it, you're going to probably do it. And yet when it comes to property, I'm guilty of this too. When I started, I just go, I've got some money, I'm going to buy a house. Great. And that's the business plan. Whereas we need to switch that. We need to make it a bit more detailed. We need to think about it a bit more long-term, I guess you could say. So what I want to talk to you today about is the long-term approach. Okay, we want to move away from this 1 year ROI model. And when I say the 1 year ROI model, I'm guilty of, I guess, sharing lots of videos that are based off the 1 year ROI. So we look at a house, we work out the return on investment, the return on the money we put in, and then we go, yes or no, that's a good deal. And in a good market, that's probably how we should evaluate a deal. But in the next year, if you do that, you literally won't be able to buy anything because the interest rates more or less screw every single deal out there unless you're buying something incredibly below market value or incredibly high in terms of cash flow. So we need to think maybe a little bit more long term than that and think about the 5-year model. Okay, let's look at the 1 year and go, okay, this property's average, and then let's go, I wonder what it earns me over 5 years. So if we take an example, okay, now these screenshots are taken off of, when I send out a property deal for my clients through the sourcing, I like to present the figures to them, and this is an example of that. So on the left-hand side is the figures for purchasing a 100 grand property, the costs involved with that. Everything from the deposit, the stamp duty, the refurb I put in is 15 grand, and I've even put in the sourcing fee there of 3.5. Now, if we assume we're putting in 25% deposit, that and all of the costs come to £48,000. So we're putting £48,000 into buying this deal, and at the end, we're projecting it's going to be worth 145,000. So 145. Now, at this point, we'll of course wanting to try and refinance. We do have to bear in mind that we're going to go for 145, but that could come back at 135, could come back at 140, 135, 130, and in which case we will be leaving more money in that deal. We could be leaving in 19,000, 24,000, whatever it is, and in which case that will then skew the ROI numbers. So we have to run different numbers. But for the purpose of this, we are going to assume that we've gone for 145. That is achievable, and that's the price we're going to refinance at. And therefore, we need to look at the money in number, which is the 48,100, and then we need to look at the money in after the refinance. So we've refinanced the deal, and we're left with £14,350. If this property was then to achieve £850, and we'd got an interest-only mortgage at 3.5%, we're looking at a lovely, 35% return on investment. Whereas if we were to do it now, where we're more probably looking at a 6% mortgage, we might even be looking at 7% one in the next few weeks. But let's go off of 6%. Our interest rate, of course, has shot up, meaning that our cash flow, our monthly profit has gone down from £429 to £202, which is a crazy difference. That literally is the difference between buying a house and not buying a house. And the ROI has gone down from 35% down to 16.95%. And most people would then walk away from this deal. They'd go, no, 16% ROI, nah, not buying that. But I think we need to start to think about, well, what if we stuck with this deal? What if we did purchase this, we put it on a 5-year fixed, and we just rode it out? Well, we take that yearly profit of £2,431.80 at the higher interest rate, the 6% product. We times that by 5, and over the 5 years, in theory, this property is going to make us £12,159. Now, I want to assume here that that's like 5 years of profit. The chances of getting all of those 5 years of profit is slim. So I want to assume here 25% we're just going to lose. It's going to go because we're going to have voids, maintenance, and we're going to have loss of rent along the way. So if we lose 25% of that, we're now left with £9,119.25. And that's our profit over 5 years. Doesn't sound that great, but that's our profit over 5 years against £14,350. All of a sudden, we're now looking at a deal which might net us 63% return on investment over 5 years. Now, I'm sorry, but I don't think, and I might be wrong here, I don't think you can go out and get 63% over the next 5 years anywhere else. You might I say that, you might if you get very lucky with a stock, you might if you put it all into crypto and then people put all their money in that again. I don't see that happening in quite as quick a turnaround. It might happen somewhere else, but I think the chances of you buying a property any other asset other than a property and earning 63% over the next 5 years with the expenses calculated in is slim, and therefore you might reconsider some of these deals. You might think about the long-term side of it. And don't forget that we haven't actually accounted for capital growth here. So if we scratch that, we're going to do another example like this. I hope this is interesting. If it's absolute garbage, you should probably tell me in the comments so then I can move past. But if not, chuck some questions in there because we'll be getting to the questions very soon. If we start again from scratch, completely different example. This time we're going to go through a capital growth example. Okay, so Dave has been kind enough to join us once again. Dave has £120,000 in capital. In 2022, so the remainder of this year, he's got to act quite quick. But let's just say he goes out and buys 4 buy-to-lets, all at £100,000. And the remaining £20,000 is put towards the fees, the stamp duty, solicitors, surveys. That will probably come in at about 20k for about 4 houses. And he puts them all onto 5-year fixed mortgages. Now, with that £120,000, he's been able to buy £400,000 worth or value of property, as you can see on the right-hand side down here. So each one's 25k deposit in. He's got 4 of them. I hope you're following because I'm moving on. In 2023, the market downturns. Houses drop. And although he thought he bought well, and all of them at £100,000, they're all now worth £90,000 if he was to sell them. But Dave doesn't care because Dave locked in a 5-year mortgage. And he realizes that you only realize the gain or the loss when you sell or when you refinance. So over the next 5 years, he can give a hoot because he's holding on to the houses and they are still cash flowing. So technically, the value is £360,000. But he's got another 4 years left on the mortgage. So he's thinking, well, I'll just wait out the 4 years, see what happens. 2027 comes around, 4 years later, the market has rebounds, it grows. His houses are now worth 120. They've gone up to where he paid them and beyond. And going up in growth from 100 to 120 is more than possible if you look back on what we've seen over the last 2-3 years. So his houses are now worth 120,000 each. Dave now has 180,000 in equity, up from his original 120. He could refinance 60 grand of that out because you have to leave 30 in each one. They've all gone up slightly, so you have to leave slightly more deposit in. But he can take out £60,000 and off he goes, and he can buy more properties because Dave played the long game. Dave stuck in this long term. He looked at the 5-year outcome rather than the 1-year outcome. And that, for me, just before we move on, is really where I'm going to be placing my concentration over the next few years. No, I'm not going to be buying anything and silly, dumb investments. Always be buying, but always be buying at the right price. And I think always be buying, but with at certain times you can play more of a short-term strategy, and sometimes you need to play a longer-term strategy. And the last couple of years, I've just, for example, bought a house in June and then sold it and completed on it in September. I probably wouldn't approach that deal in any of the same way if I found it now. So I think it's really important to know that the last 2-3 years have been a very, short-term market. We can buy, we can sell, we can make money easily, we can refinance easily. Now we need to think about more long-term. Okay, my money's going to be tied up longer. I'm going to need to look at the ROI over a longer period of time. And that is the main thing, thing I'll be taking into my investing over the next 2 years. Number 4, understand the opportunity in front of you, because there is a big opportunity in front of you. Okay, don't let the macroeconomics make your decision go off of your own personal investing plans. So we've just discussed what you can do personally in terms of long term. So then take your plans. Right, I want to continue buying 1 buy-to-let a year, and don't let the overall macro make the decision for you. Just continue trying to buy that one. If your goal was to buy 1 for 10 years, 1 house a year for 10 years, continue buying that one. Focus on the things that you can control and calculate the things that you can't control. This was a quote or a saying I heard recently, and that resonated with me because in these periods of time, we can't control a lot of things. But what we can control is your investment plans. What is your plan? What is your goal? We can control your capital that's sitting there in the bank. Do you want to just leave it in the bank for the next 5 years and just melting away to inflation and other aspects that really isn't a good use of your money? And we should be thinking about how can we invest that, whether that is property or not. And then you can obviously control your viewings, your offers, your follow-ups, how much effort that you put into this. What you can't control and what you should calculate are things like interest rates, cash flow, and the mortgage products. So because we can't control them, what we have to do is calculate them and then try and de-risk them. Try and look at our investment and go, right, this is how much they're going to cost. This is how much they're going to affect the deal as such. I don't know if I'm kind of like glitching in and out in terms of my voice. in terms of if I'm freezing. I apologize if I am. Okay, good. Okay, looks like we're good. Interest rates have been historically low for over a decade. When I saw this graph, I thought, shite, we really have had it really good the last few years. So, you can see how low we've had it in comparison to the decades before. So to be quite frank, maybe this is a bit brutal, but if you can't invest now, then you're probably in trouble. You probably shouldn't invest because we're still within very low rates in comparison to where we have been in the past. With that said, we're at a low base rate. Obviously, the banks are adding on whacking great big margins right now, which I believe needs to be controlled a bit more because I don't think that's fair. But we're at historically low base rates. But I think there's definitely room for us to be better investors. We don't have to just sit and not do anything for the next few years. We just have to become better investors. And this brings me on to the two types of people. I've used this graphic before, actually. I like this graphic. There's two types of people, and one of them will stop and one of them will continue. Okay, the person that stops is like my friend Peter here, and they'll come to me in 2025, as many people have the last couple of years, and I mean this in the nicest, kind-hearted way possible, but they'll say, Justin, the market's just too busy and it's hard and I can't find a good deal. This is ridiculous, okay? And that's the sort of person that will read these headlines, they will panic and they'll go, well, I'm not investing the next few years. And then you've got the other person who has more of what I like to call an unlocked brain. They're more, okay, they're open to the fact that there is probably an opportunity here. When everything feels a bit unnerving, that probably means there's an opportunity. So you will see the opportunities that others don't, and you will create wealth and a life that others can't because they might miss this opportunity. So there is nothing wrong with if I've just gone over that and you think I probably am the stop person, because that was me. In 2020, the pandemic hit and I just stopped at the end of that year. I bought my first buy to let. My plan was to buy another one that year. And I thought, no, I'm just going to sit on my hands for 6 months and see what plays out. And what actually I did was I missed a huge opportunity where prices kind of froze whilst the lockdown was happening. And then when everyone came out, then the prices started to rise. And even then I missed the opportunity a bit. So I have been this person. I am now this person, I hope. And you'll see that over the next couple of years. I will continue to source. I will continue to invest in property. And if you don't invest in property, let's face it, what else are you going to invest into right now in order to protect your money? Are you going to invest in stocks, which are currently down? Are you going to invest in crypto, which is currently very much down? I don't mean to say that with a smile. Are you going to invest in businesses which, although are not, they're obviously individual and to their individual business itself, it's probably the most risky time over the next few years for people to invest in businesses because that could really go one of two ways. And I believe, obviously, I've literally just told you, be greedy when others are fearful, and then I'm telling you to not invest in stocks or crypto. But there is obviously a good buying opportunity with stocks, crypto. But for me, I like the fact that property pays me even when the price is down, whereas a lot of these don't, or they don't pay me very well when the price is down. Whereas business, I do think there is a good opportunity there. I don't know enough about it, and hence why I go towards property, because what I know, and it's a good asset to invest into. Now, I hope those last bits have been interesting, useful. I think for me, it's just unlocking. I'm wanting to help people understand what interest rates are, what the cash flow of property is going to look like, and then how to take more of a long-term approach. As always, I like to do this in my presentations, which is, what do you want your life to look like? I do this because I think this should be what everyone thinks about before even investing. Is the ultimate goal for you leaving your job? It was for me. Is the ultimate goal for you actually I really like my job, but I want to get some more materialistic things, which, let's face it, that is not a problem. It's a good thing. If we've got enough money to go and spend and enjoy our lives, why not? So do you want a new home? Do you want a car? Do you want a watch, handbag, holidays, whatever it is? Is it the comfort of additional income? Maybe it is just being able to go on holiday at the drop of a hat, not even having to think about the costs involved. For me, it was definitely working for myself. And as I've now achieved that, and genuinely it's the best thing I've achieved in my career so far, now I moved on a bit further to going, right, I want to change the way people learn and invest in property through Propertyx, which I hope kind of like what tonight is. It's like helping you understand what is ahead of us and helping you understand that it's okay to be a bit worried, but we need to push through this and actually see what opportunity is in front of us. And no matter which one of those you are, you need to have this. I always share this on here because I think it's so important. We need to reverse engineer the process, which is, I want to earn this amount from property. How many properties do I need? How many years is that going to take me? In this example, this person, it's not actually me, wants £3,000 per month over the next 5 to 6 years. So they've worked out that on average, they need to buy 2 to 3 buy-to-lets per year. That might now be drawn out a little bit due to what we have going on, but you just need to build a plan and then stick to that plan. To recap some points before we go into the Q&A, reprogram your mind to think long-term. Be greedy when others are fearful. Obviously, take calculated risks. I will add to that. We need to acquire knowledge and skills because they are your greatest assets and they are things that you can't lose and you can take forward in life. That's something I've really doubled down on, I'd say, the last couple of years. And then think about your made it moment. Think about what drives you, because on the days that you don't want to get up and do viewings, do follow-ups, make offers, what have you, that's the thing that's going to push you forward. Every time I thought about the fact I can't be bothered, I thought about, I want to work full-time property. I hate my job. And genuinely, that drove me forward. The Q&A is coming up, but as promised at the beginning, I do have an exclusive offer for you. So bear with me because I'm talking to you about the Propertyx program. Now, it's been closed since April, and I want to introduce you to the first results-led education company, which is Propertyx. It's the Propertyx program. This is the 2.0 version. To give you, this is actually a few months back now that I did this, but it was such a good example that I want to show you kind of what is achievable through the program. And that is, I sent out just like a questionnaire to the current members, and it was like a feedback form kind of questionnaire sort of thing. I said, what were the results and what action have you taken since joining the program? And the first 3 responses which came in within a few minutes was, one of them was bought 2 properties so far, another was purchased first buy-to-let, more planned, and then the other one's bought my first property. So genuinely, I want to see results from people that are on the program. That is so important to me, and that's why you see me open and close the program. It's really important for me to do that, because otherwise I'll be taking on too many people. I wouldn't be able to control it. I want control. I want a select group of people. And I want people like Vivian. Vivian, since joining the program, she purchased her first buy-to-let in Stoke. She genuinely was amazing. Her determination, the amount of one-to-one calls where we just drilled through buy-to-let analysis, going through areas of Stoke, through areas of Liverpool, which she did also consider. And she's gone on to purchase her first buy-to-let. And that's what I want from the program. I want it to help you purchase your buy-to-let with confidence. James, who's been with me just under 12 months, he's purchased 2 buy-to-lets. He has 3 more in conveyancing right now. So he should have 5 by the end of 2022. James is doing genuinely incredible. And then Joseph has just built his first HMO, actually. So I've helped a couple of people get HMOs, even though I don't own any HMOs myself. But Joseph, obviously, again, he just really doubled down, led with it, and he successfully has renovated this property. He will be refinancing it, and he's currently renting the rooms out. There's just like 3 of honestly, have loads, and I do mean it, of good success stories. The Propertyx program is 12 months of support. It's an 8-hour video library with over 35 videos, really detailed, to help you get that basis of knowledge. We then move you over, once you've got that good basis of knowledge and you want to get out on viewings, we then move you over to the mentoring sessions. We go through the mentoring sessions to talk about areas, how to do area analysis, how to work with agents, do buy-to-let analysis, one-to-one WhatsApp support. No one else can offer one-to-one because everyone else is taking hundreds of thousands of people on. I'm just taking on a small group because my main job is property investing, property sourcing, and then this is something I do on the side of that as well. Loads of documents and templates included as well, literally loads, which I include. And then first access to source properties, which has actually been more of a valuable one than I realized. So when I get a deal, I tend to give my group 24 hours notice. They get first access to the properties that I source. I actually source quite a lot of houses now, anywhere between 6 and 10 per month. And quite a few of them do go to the Propertyx program members. So it's beginners only. I want to be able to add value, as much value as possible. 15 spaces available, first come, first serve. And I do genuinely mean, I'm not just saying there's 15 spaces to sell it to you. I'm saying it because I don't want to take on more than that. I just want to take on 15. As I say, it's not my primary income. First come, first serve. Closing date is next week. And an exclusive offer for you tonight, for anyone that's sitting there thinking, actually, I do want to join this enrollment. There is, I'll include an additional one-to-one onboarding session. This will be an hour and a half, so 90 minutes of an additional session, which can be held at my office. So you can come to my office, we can do your session, we can go over lunch, or we can do it over Zoom. And you will also get free entry to the next in-person training day, which is worth £250. And that will probably be at the beginning of December, or there'll be one next year as well. So you'll get free entry included as well. So it's quite a nice bundle there. If you go on the website tonight, in the next hour or so, and you click join, then you will get that exclusive offer included. Now, thank you for bearing with me. I really, really hope that you guys do want to be part of the Propertyx program. I love coming on here, giving value as well. So thank you very much to everyone that has stuck with me to 50 minutes in. I honestly really appreciate you. We are hitting the Q&A now, so let's try and add some value here. I appreciate. I haven't gone through the comments yet. Normally there's some hate, but I appreciate that sometimes people really like me, sometimes people really don't. So we'll just work with what we have, and we'll go from there. So let me just switch her up a little bit. Bear with me, I'm just trying to pick up some questions here. Given your Dave examples of the economy, do you think it will be best to focus on buy-to-let needing no work, as flips might not get the return we are used to? I think that is a very good thing to think about the next few years, and it's potentially where I might start to switch my strategy. I've very much gone for properties where I want to do the refurb. I want to completely replace everything because I want to drive up that value, try and get a bit more, higher refinance, or I want to be able to flip and sell for a profit, as I did one recently. But with that said, I think that the chances are we're going to get down valuations. It's going to become harder to sell properties. And therefore, we should maybe think about more turnkey properties, more ready to go buy-to-lets, as I like to say, where they are literally buy, put on the rental market, get a tenant in there, cash flow. Now, in the short term, of course, we are tying up more money, but potentially there's less risk involved. And then in the long term, we are hoping that we have bought them at the right price so they do go up in value. And I would just let the price lead you, the return on investment over 1 year, then 5 years, and then think about the opportunity cost there. If I'm tying up a lot of money, what else would I be doing with that money if I don't invest it? And then I guess weigh it up from there. I would also just add to that lastly before I move on to the next question, and that is, if we are looking for a property, a buy-to-let that needs no work, we need to find one that genuinely needs no work. I see a lot of people come to me and say, "Oh, I've got a turnkey buy-to-let. Oh, but it does need the flooring done, or it does need plastering in those rooms, or it does need painting." So what I would say is that I would try and get a property that genuinely doesn't need much doing to it, because otherwise that will negatively impact your cash flow. The maintenance could really put a downer, I guess, on the cash flow of your property. But good question. Thank you, Amy. Thanks for chucking that one in there. Really useful. Let's see what else we've got on here. There is no upswing to the recession in terms of property. Property is not decreasing, not currently anyway. No, it hasn't yet. I mean, I would say I've seen a few more price reductions. I've seen fall throughs a bit more. But yeah, we've not seen huge impacts yet. That could change maybe at the end of Q3, Q4, if like the numbers come out where X amount of houses are falling through, X amount of houses are reducing their prices. That doesn't really help, and that kind of ends up having a knock-on effect. Also, the fact that 40% of mortgages have been taken off the market can mean that for the next 3 months it's a lot harder to get mortgage lending, which won't affect us in the next 3 months, but then the 3 to 6 months after that. Property is always kind of like 6 to 9 months behind So really we'll see the knock-on effect of less mortgage products probably at the beginning of 2023. Sorry, bear with me. Harry, in example 1 for cash flow assumed a 45% increase on the post-refurb price. How realistic is this today for a BRR? Yeah, it's a great question, actually. I mean, I have genuinely sourced a lot of houses like that on paper, but like I said in that example, we are assuming £145,000 as our end value, but we have to account for the fact that could come back at 135, 130, and therefore we might no longer be leaving in 15k, we might be leaving in 19 or 25, and so on. But I think the important thing is that if you've managed to buy a house and the cost to acquire it and refurbish it were 48,000, and at the end maybe now you're leaving in 25, that's still probably less than if you bought a ready-to-go buy-to-let, and now you've got a brand new house that's hopefully not going to cause you any maintenance issues in the next few years. In terms of uplift, yeah, I think it might be difficult to get the uplift from the refinances. I think it might become easier actually to find properties where you can get them, at a lower price. So the last couple of years we've gone, oh, it's too hard, the market's too hot, I can't find good enough deals, but I could get the uplift. Now it's going to be the other way. Now I'll be like, oh, I can find a good deal, oh, but it's too hard to get the uplift. There's always going to be a downfall. We just need to work out where it is, and we need to try and continue working with it, really. And in this case, it will probably be leaving in more money for a longer period of time. Wicked Witch watches, another good one. What were you saying? People are still fighting and bidding against each other due to the housing shortage. Throw into that the rising interest rate housing market hasn't changed yet. Same kind of thing. I think we'll start to see a delay on that, but we will start to see that. It will suddenly, unfortunately, hit, and then the media will have a field day when they see some stats come out. That's when they'll really go to town. Rising interest rates will make properties unaffordable. Young investor is responding to Wicked there. And that is right. The rising interest rates is what is going to have a biggest impact here. It will stop people investing. It will make it harder for homeowners to keep their properties when they refinance. And it really will have a knock-on effect the longer that the interest rates are higher. Amy, again, thanks for another question, Amy. Also, when it comes to remortgage, will you still focus on interest only, and will you go for a 3 or 5 year fix? That's a fantastic question. If you can find a good 3-year product, I would probably be inclined to go for that. I think 1 or 2 years, we won't see it. We'll almost be refinancing at a bad time, maybe even higher interest rates. I think we might start to see better rates at 3 years, 4 years, 5 years. Based on the fact that you can't get a huge amount of 3-year products, I'd probably be looking at the best rate that I can find at 5 years and just lock it in. And then hope that in 5 years' time, we're in a better situation where you can make more profit from that property. But yeah, I will still be going for interest only. In terms of like my portfolio, I think it's for the sort of first 5 to 10 years of my portfolio growth, I'm really just focusing on the growth and therefore the cash flow of those properties to help me buy more. As I get past the 10-year mark, I will start to take a percentage of my portfolio that are cash flowing well, change them over to repayment so I can start to pay down some of that debt. I certainly don't need to do that in the short term though. I still feel young at 30, and therefore I will continue to invest and on interest only. So I'd say it would probably be a percentage every 5 years after 10 years that I start to switch over as and when they come up for remortgage. But I think got plenty of years yet before I need to worry too much, hopefully. Richard, good to see you on here. How will down valuations affect your projected growth? And is there any way to mitigate the impact or at least the risk? Do you know what? I wish there was. I wish there was something better I could say to this. I just think this comes with, time. I think this comes with, longevity, experience in the game to be able to give a better answer on this, which maybe I don't have. But what I would say to you is that I think it comes to, I hate to say it, going back to that kind of longer structure again, okay, reverting to taking a higher vision plan or a higher viewpoint, going instead of what will this do over the next 2 years, what will this do over the next 5 years? Because a good friend of mine who took a large chunk out of his business back in 2012 and went off and bought over 10 buy-to-lets. He bought them at fantastic prices. 10 of these, I think it was over 10 buy-to-lets in 2012, 2013, 2014, but couldn't then even refinance them to where he wanted to or where he thought they truly believed and believed the value to be until like 2017, 2018. And now his portfolio is absolutely blown up and he's sitting on loads of cash, loads of capital. But had he tried to do that in 1 or 2 years, he just couldn't. But the fact is that he's done it over, 5 years, a decade, that now he's started to see the true growth, the true results of sitting on all of those properties, thinking, man, I thought I bought these at a good price. And I know they're worth more than that. I put all this money into them. They're earning me money each month. I think they're worth, 90 or 100, but I'm only getting to refinance them at 80, sitting on them. Bang. Okay. And then when they are worth 100, when they're worth 110, 120, now he's refinancing them, taking all that money out. So I guess there's no short-term answer to that, which is a shame. But that's just what we have to live with, I think, for the upcoming few years. Thank you, Jonah. Great to see you here, mate. Really appreciate the support as always. Matthew, what's the general consensus amongst your network with regards to a 10-year, 15-year or beyond fixed mortgages? Appreciate the interest rates are higher, but offers great long-term security. That's a really good one, Matthew, in the sense that I think how I'd start that is I do actually have a friend who who I talked to quite a bit, and he's been on a previous video of mine on YouTube, and he was smart enough to actually lock in a 10-year deal at about 0.9 or 0.98. Obviously, it's on a personal investment mortgage, not a limited company one. But he saw this a year or two ago. The rates were unbelievable. I don't know how he managed to get it, and he's locked it in for 10 years. Obviously, he's laughing probably now, but the actual amount of 10 or 15-year products, I believe, is quite a small amount for one. So therefore, they might take advantage of that with the interest rates right now. If you can find one, potentially might be worth exploring that. It's not the approach maybe that I would take. Whilst we have seen much higher interest rates in previous decades, I believe that we may well get back down. I could be completely wrong here, so don't shoot the messenger. Don't shoot me for getting it wrong. I believe at some point, whether it's 2026, 2028, 2030, I think we will start to see a taper off again. We might even revisit the days of 3% limited company mortgages, 4% limited company mortgages. At that point, I would definitely look to try and then lock in a longer term deal, knowing what I know now. But it's taken obviously time and seeing this happen for me to go, wow, yeah, I would actually take security now over trying to get the best rate possible. So again, probably not like a definite answer for you there. I personally would opt for renewing like every 5 years until I get like a solid rate. That comes with an element of risk. If you are someone that likes to de-risk things as much as possible, then I would probably say to you, actually, yeah, maybe locking in that long term, just working out what the cash flow is. If it does well, just lock it in for as long as possible. And if that helps you sleep at night, helps you grow your portfolio because you don't have to worry about that house, then that's probably very important. On to the next one. Gary, thanks for the question. Justin, 2 questions. Is an offer ever too low? If we are guessing market may fall 10%, 20% over the next couple of years, do you just run the numbers to try and get low deals? Yeah, I mean, as harsh as it sounds, without answering the main part of the question yet, I think it's important that we are putting out a volume of offers. And for me, it doesn't necessarily matter how low I'm going within reason. I think there is an art to negotiation. And if there's a house on that's 100,000 and you go in at 50,000, then you're potentially going to ruin any relationship that could have come from the owner or that estate agent. Whereas if you can run the numbers on that property and go, well, look, listen, the maximum I can pay actually to buy that house in this current market to get the deal I want is 75, then maybe I'll go in at 69. might, psychologically looks a little bit lower than 70. Then I might go in at 71, and I might try and get it agreed at 74 or 75. I do think it's important. I think it's a bit cheesy when people say it, but I do think it's important to try and get that win-win where the estate agent, the owner feel great on their side. You feel like you've bought it at a price which is realistic for you, even with this drop. And that's the perfect relationship going forward, because then someone is less likely to try and pull out at a later date. Whereas if you've really forced someone down to 60,000, there could be issues that come up along the road. There might not be. So what I try to do is put out a volume of offers, but I like those offers to be realistic. So I'll use my spreadsheets. I will run, what is the most I can pay for this, and then kind of try and work an offer within 5 to 10,000 of that, and then kind of work my way up in increments. And I do think the volume of offers will be really important the next couple of years. And more than that, the volume of follow-ups. So the power, I think, over the next 6 months of just talking to agents, following up on houses you previously made offers on that were rejected, and obviously following up on properties that have been in conveyancing for a long time, will come back. The last couple of years, estate agents haven't needed us. They've got 10 more investors every day that walk through their door. Now that'll start to slow down. Now they want to talk to us again. They might do anyway. And that will be great to see and great to utilize as well. Tanik, thank you ever so much. Appreciate you joining tonight, and thank you. And yeah, we'll see you in your one-to-one. Tanik's on the program there, so great to see her on the live tonight. Matt, do you plan on doing any HMOs in the future? I tell you what, I would, if I was living in my little dream world, I say dream world, I'll make it happen. I want to go down the route of purchasing, not necessarily like a block of flats, but certainly like flats under the same roof and multiple units under the same roof. I do like the idea of the cash flow side of things from a HMO, but it's the additional work, I think, in order to set one up, to maintain one, to chase the rent out of people. And that's coming from someone that doesn't do it. So, there's probably multiple people on here or that, follow me that would say, what are you doing? You're crazy. You're missing out such an opportunity. My average HMO makes 2,000 profit a month. And, it would take me 10 buy-to-lets to replace the same income there. But for me, I just prefer, I am really hands-off with mine, like super hands-off. And that's because I pay managing agents. That's because I'm 5 hours away. But if I can maintain that level of being hands-off, or at least probably increase a little bit, but over 20 houses, 30 houses, and in fact, I can start to get some of them under the same roof and the same location with the same managing agent, the same tenant demographic, then I can start to control that a bit more. And I'm a big believer in actually that if I grow to 20 houses, I'll probably then constrict to 15, because 5 of those houses that I bought along the way will just be a nuisance. And it's unfortunately just the way some houses goes. Some profit really well, some have tenant problems or just house problems. So I might grow up to 20 houses. I might then constrict to 15 and then grow up to 30 and then back to 25, and so on. But in the short answer to the question is I'm not really. If the perfect one walked through the door, I've got the money, I'd give it a crack, because I think it's great to learn new things, and I like to learn new things. But for me, I'd like to stick to the single let model and just diversify the way I use that a bit. But that's not to say you shouldn't do HMOs, because I think it's a great strategy. Gary, secondly, if it's going to drop soon, I guess obviously the market's going to drop soon. Are we best waiting for 6 months or so? Gary, go back and listen to the live session. I'd literally told you not to do that, but do what you feel comfortable with. I am not a financial advisor. I'm taking the things I've learned the last few years. And certainly when I sat on my hands for the 6 to 8 month period, that was the worst thing I ever did. I missed out on so many good opportunities because I thought, oh yeah, I'll wait 6 months, then I'll jump in and get the good deals. But truly, when do we know when it's the top of the market or when it's the bottom of the market? When do we know that we're going to see a good deal or not? We don't, okay? The truth of the matter is, I bought a property earlier this year, which most people thought was crazy. How did I manage to buy a house for 54,000 on a street where even the worst houses are selling for 75? How did I manage that in a hotter market? And that's because you just always be looking, always be buying. You might just come across something. You might have to see 200 terrible houses first, like online or view obviously a lot of them, but properties, certainly always available, and it's not like a stock, a stock or crypto where you have to buy it at the level what the market is dictating. With property, you have to buy it at the level that you're able to negotiate it out with the vendor, with the estate agent. So that's my viewpoint, but do what you think is best for you and your investing situation. Excuse me, just take a drink there. We'll where are we at? We're at 1 hour 10. Can't believe there's so many of you that stuck around, so thank you very much. What we'll do is we'll keep rolling for another 5 to 10 minutes. So I'll try and answer as many as I can. I would like to ask about corporate lets, especially trying to contact potential leads with direct to vendor. D2V is direct to vendor, so like writing a letter to the owners, for anyone that doesn't know. What would you say to landlords who are worried about insurance companies looking at it as subletting? To be honest with you, that's more like a rent-to-rent question. That's something I'm not, just being completely transparent, I really wish I could answer that. I don't do corporate lets and haven't done them. Can't teach them in the program either. So I'm really sorry on that one. I will, if you drop me a message on Instagram, I will try and introduce you to someone that can help you with that. But that's beyond me, so apologies. Moving on, would you still be buying cash if you could, or is there an advantage in changing market to buy with a mortgage? The last 2 properties I have bought with cash. That is, your solicitor doesn't have to. Oh, we lost the audio? Yeah. We've lost the audio, we're just changing the audio. Am I back? We'll be in a sec. Thank you. Cool. Sorry, I don't know. I think you lost me there. My audio ran out of battery, but I'm back. Hope I'm back. So when it comes to buying cash, I don't know how much of that you caught or not, but basically I bought the last 2 properties cash. I've used a combination of my own and investors' money. And the reason I do that is because then I'm much quicker. I don't have to satisfy the lender when I'm buying something. And what I mean by that is, when my solicitor is helping me purchase a property, if I'm doing that with the help of a mortgage company, I've got to do the application, it's got to go to the underwriters, they've got to do the valuation, and then the solicitor has to get everything that she's learned about the property. She's got to ask all the questions that then the lender wants to know and ask all the questions that I want to know. And that is quite often why it's like a 3 to 4 month transaction just to buy somewhere. Whereas if I purchase that cash and I ask all the right questions that I should do anyway about the house, anything that I think might come up in a refinance or anything I think that might come up in a sale, I can probably get that done in 6 weeks. These days, probably more like 8 weeks, even with cash. So that's why I like to do it, because then I can get hold of it quicker. I can do the refurbishment quicker. I can refinance or sell it quicker. And let me just check I'm answering that question right. Would you still be buying cash if you could, or is there an advantage in a changing market to buy with a mortgage? I mean, the downside to cash is the fact that if you do then go to refinance, you might not get as much out of it as you want, and then you've tied up more money than you want. In that case, obviously, I'd say it's good to use a mortgage. But what you will find is that if you genuinely want the best deals in a downturning market, then being able to buy with cash is what's going to help you get the good prices, get the good deals, because it's the mortgage that slows things down. It's the mortgage lender that likes to de-risk things and might come back and say, I know you've agreed to buy at 100. We don't think it's worth 100 now. We think the market's dropped. We think it's now worth 85. And that's where these issues start to come up. So if it's a genuinely really good purchase, I would just move in, purchase it with cash, and then try to refinance or sell it quickly. I think that's probably the best move. And that's what I will be doing with purchases I make. Hey, Druv, good to have you on here. Druv's also on the program. It's good to have a few of you on here from the program. I do appreciate you all joining and supporting. Thanks for the session, Justin. Would you suggest to diversify between stocks and properties, or would you rather save as much capital and put into property? Again, this is a personal thing. It's like, comes back to that I'm not a financial advisor thing. But what I would say is when you see people do well, I believe it's usually because they have full focus and full attention on something, whether that be growing a business, growing a property portfolio, or obviously investing heavily in stocks like Warren Buffett, for example, obviously very well. With that being said, whilst I think we should really weight our decision making into one thing, which for me, obviously, I'm very focused on growing my business right now. So that's a lot of attention, a lot of focus there. And therefore, everything else is kind of going into property, not really doing much elsewhere. A very small percentage of things is going into stocks. And the reason I do that, and the reason I maybe suggest to you that is to maybe have a focus and then do a percentage into something else, is because it is always good to diversify. I don't want to give you advice that maybe in the future leads you the wrong way. And we don't know where we're going to sit in 10 years, 20 years, 30 years from now. What is going to be the winning racehorse? Is it the property? Is it stocks? We truly don't know. I think everything indicates and sort of in the direction of property, because we can leverage it with debt, because we know the value of money goes down. So if we take out debt, the value of money goes down, our equity just goes up. I think these properties obviously pay us money. But that isn't to say that because I've told you that, go and do all property. Again, it just comes down to maybe be much heavy, more heavy on one of those, and then have a small portion going into stocks or whatever you invest into on the side, because you then have almost like a backup plan to that as well. Cheers, Richard. Yeah, solid. Yeah. It's very, very frustrating. I'm sorry to hear you've had that by the sounds of it. So 100% play the long game. I really agree with that. How much is interest rates now for buy-to-lets? I mean, it's honestly changing every week, and I think it's going to change again in the next week or so. So be prepared. If you are about to put in a mortgage application, chase your lender, so your broker up right now. Get that application in, so then the lender has to, honour that rate. I think so. They were obviously, go back a few months, they were like 3.5% for a limited company. Now we're looking at like 6%. Like last week we were looking at like 5.5%. Now we're looking at like 6.5%. Next week it might be even like 7.5%. So it's very hard to give you a definitive on that. It changes depending on the lender and how up to date they are, and depends whose products are out there. But I would say that it has gone up considerably recently. Eugen, how much tax do you pay for your first buy-to-let property? Are you from the Hmos? Is that you? I to be honest with you, not much, because I had so many expenses in my business in the first year or two. But yeah, you would pay 19% corporation tax on your profits. So if your buy-to-lets obviously earns a certain amount of profit per year, 3,000 or 3,500, you'll pay 19% corporation tax on that. If you run it through a limited company, if you run it through your personal name, then you are subject to much higher tax than that. 20 or 40%, depending on the job that you have. So I'm just pouring myself some more water. I think I might have hit all the questions. I don't think I've ever done that before. Any last minute questions? I'm heading off at 1 hour 20. I think we've had a great day, great session, and I thoroughly appreciate you all coming on. As mentioned, the Propertyx program is here. 12 months of support, big video library, mentoring sessions that you can use at your will, one-to-one with WhatsApp support, lots of documents, first access to source properties, and obviously a limited space, because I just want to work with a small select group of you and make sure you see success. And there is a special offer on tonight, an exclusive offer of the one-to-one onboarding session at my office or on Zoom, and then you also get free entry to the next in-person training day, which is also at my office, and that's 5 hours and lunch. I'll give you some M&S special lunch. So it would be great to have you on the program. If you are thinking about getting into property and you want someone as like a second opinion, if you want support, I'm here. I truly appreciate everyone that's come on tonight, and I hope I've got through all of the questions. If I haven't, drop me a message on Instagram. Massively appreciate you all. Hope you have a great Monday evening, and don't forget to play the long game. Okay, play the long game. Let's all do well during this recession, if there's a recession. Let's do well during this downturn, should I say. Have a great evening, and I'll speak to you all very soon.